All right, good afternoon. I'm with a new guest on Goldfinger Capital. His name is Vince Lanci. He runs a Substack called GoldFix. I am a founder of GoldFix. Vince's emails and his content is extremely valuable, and I look forward to his updates every day. Vince, how are you?
Robert, thank you for having me on, and thank you for being a founder. And we discussed on the air, now that I know where your site is, I'm going to be subscribing to your stuff because, well, I don't really know a lot about miners these days, so I need to do that. But I appreciate that. Thanks for having me on. I'm glad we finally got to do this.
Yeah, absolutely. Look, let's get into your background first and what got you into financial markets and what attracted you to precious metals and what you're doing today.
Right. I think my path is, most of the metals people that I talk to, and I'm not so sure about you, but I would think so, are very hard money oriented. And I come from a neo-Keynesian background. I'm not hard money oriented. I wasn't trained that way. I was trained in derivatives as an options market maker. I was trained in finance, high finance, all that derivative stuff. And I worked at a company called Cooper Neff, and they were very big commodities market makers. I put them on the level of Susquehanna or CRT back in the day, or even Timber Hill. But my first exposure, they put me in the precious metals pits. And so precious metals, I'm a derivatives person. I'm trading options. I'm looking at statistics. I'm modeling markets. I don't care about the market. There's an arrogance among futures and derivatives traders. It's like, oh, we don't care about the thing. We just want to trade the paper around the thing. And after doing it for a couple of years, I had to learn the fundamentals. So I got exposed to it. I learned the fundamentals because, well, on more than one occasion, not knowing the fundamentals cost me a lot of money. Things like short squeezes, backwardation in silver, gold as money versus gold as a commodity. Anyway, so I got pretty well versed in it, and then I went into energy. I started trading energy, and I got very familiar with energy as well. But over the years, people would ask me about metals because I think there's just so many good energy people out there, and there really has been a lack of knowledgeable metals people. So I kind of got sucked into it. Your audience, you may not know him, but Larry Benedict is one of the original market wizards. In Schwager's book, he started like an educational thing, and he was picking what he would deem experts, and he picked me, and I'm like, oh, and I was like, derivatives, options, because that's my expertise. I have a published paper. I teach a class at UConn. He's like, no, I got one of those. I need you for metals. I'm like, all right, I guess I'll do metals. But my next education in metals got really deep, and market structure and what have you. And so here I am. And during COVID, I started GoldFix almost as a hobby. There was a local bar that I was hanging out in, and no one was there, so I would go there, and I started broadcasting from a tavern, and it became what it is now. So that's it. That's how I got involved in precious metals. Now I am a hard money person because I understand it. Luckily.
So you're actually a relatively new convert to gold and silver. I mean, the pandemic was 2020.
Well, I mean, not a new convert. I mean, I don't want to cheapen my brand here. I was trading silver and gold and was studying the fundamentals in 1993.
Okay. And
I traded silver and gold options and physical and futures on the floor from 93 to 03. And then I left the floor in 03 and traded energy and precious metals as an options market maker on the COMEX for 10 years as a fund manager. And during that time, even though I was a derivatives guy, I started taking physical delivery because I started to understand it. So like between 2007 and 2012, I was buying. Of course, I bought cheap in 2007, and then I bought expensive in 2011. Back in those days, I was start reading Paulson, John Paulson, and I had a mentor on the physical side who ran the Goldman Sachs Commodity Index. His name was Joe Mazzella, and he would call me for derivatives information. So between 1999 and 2012, I got a massive education on the physical side, and that was because Joe would call me and say, "I need to model some derivative. Can you help me out?" I'd be like, "Yeah, sure." And then I would call him. This is a partner at Goldman at the time, and I would call him and I'd say, "Why is gold doing this?" And he would tell me. He's like, "Oh, well, there's a little bit of tightness. There's a strike here. Why is silver doing it?" I'm like, "Oh, wow, this is actually pretty cool commodity." So I started to read more about them, and I got really, I was already fundamentally schooled in silver, but I got really deep involved to the point where I was involved in multiple short squeezes in gold and silver and didn't know at the time. And then, right. Well, it's like in here, I'll give you a couple dates, right? In 1994, George Soros tried to corner gold. You're not going to see this in the press, but it's true. He was considering cornering gold after fresh off his home run in London. And when he went to do it, they said, "Don't you even think about it." And so he squeezed silver in 94. And that was an aborted squeeze that ended right away because his broker that he used was Salomon Brothers. And Solly was just embroiled in the whole treasury thing. So that's 94. 97, Warren Buffett says, "Hey, that's a good idea. I'll squeeze silver."
I remember the Warren Buffett squeeze in 97. Yep.
Right. I was freaking out. I mean, that was my first seven-figure, day, 7-figure week, let's call it that way. But I was still a young guy, and it was tremendous. And then 99 comes, right? And now I'm still trading on the floor in options, and 99 comes. And now here's the real education comes in 99, and it's about gold. And you definitely know about this. In 99, Goldman Sachs wanted a bigger market share in the gold mining industry. A lot of it at the time was, at the time they were called Swiss Bank O'Connor. So basically, a lot of the European banks had the production business. And so what Goldman did is Goldman went on a marketing binge, an aggressive binge to get miners to steal them away. And they did it by, you're going to love this if you understand miners. I know you do. They would go to a miner that was, say, worth triple B credit. And they'd say, "We're going to give you double A credit." And so Ashanti and Cambior became clients of Goldman. And they were worth, let's say, a $20 million line of credit. Goldman gave them $50 million, gave them $100 million. And Goldman said, "You need to sell calls." And they sold calls to Goldman. And Goldman sold those calls to me, because that's how they play their arbitrage game. And this is how I learned about the physical. And then the market exploded. This is 1999. This is the Y2K thing. The market went from 250 to 350, but volatility in options went from 5% to 100%. Okay. Now the question is, so I was in it. And I'm like, why did that happen? And this is where the fundamentals come in. I go, what happened? And I found out, this is where I was talking to Joe. I go, "What happened, Joe?" He goes, "Well," remember he's at Goldman at the time. He goes, "Well, we did a really aggressive thing. We wanted to go get Ashanti and Cambior. And so we gave them these swap deals. We gave them these big lines of credit that they shouldn't have had. And they maxed them out. And then gold went up and the Y2K kind of freaked some people out. And we gave them a margin call. They had to put money up that they didn't have anymore. We closed their line of credit essentially."
Oh, and I go, my God.
Okay, right, exactly. So I went, so what happened? He said, "Well, the credit department got their ass handed to them because they defaulted. Ashanti and Cambior defaulted. That's why Ashanti's owned by, what are they owned by? Rand? Rand bought them or whatever."
Well, but now it's Anglo Gold Ashanti. It's a merged entity.
Yeah. So I mean, this is a great. This story has legs because it just keeps giving me dividends, right? So over the years, so now I'm saying to him, wait a minute. This is like me being naive. They're gold miners. How are they getting hurt because gold's rallying? He goes, well, we told them they should sell calls and buy puts because everybody in those days was like stressing for cash flow, right? Buy puts, sell calls, buy puts, sell calls. And they were over hedging their calls.
So they were over hedging, and the mine output was not matching the amount of hedging they were doing, and they got a margin call due to the short-term extreme market volatility.
Exactly. But here's the punchline. Like, if you're like, there's no such, anyone who says there's no such thing as manipulation, well, this is not manipulation, but it may as well be. I was on the floor when this happened. It's a little war story. And what I noticed, there was a big ruckus over in one corner of the futures ring. And I don't care about futures. I'm in the options ring, standing there with my little calculators. And at the time, it was so bad. It was so busy for this time period that this is like crazy stuff. This is like Trading Places stuff, right? Somebody took a pair of scissors and cut a phone line to a trader who was trying to get in the ring to do something. And that was a Goldman phone. And I found that later on what happened. The credit department in the bank said Ashanti's going to default. You're the first person I'm telling this story to outside of my little niche because I know you'll get it. The credit department at Goldman says Ashanti's going to default. The trading side of the bank said, wait a minute, they're going to default? What's their position? Oh, there's short calls. Oh, there's short futures. Oh, they don't have metal. All right. I guess we're just going to buy everything we can before they come to the market and buy. So the trading side made like 5 times what the credit side lost. Front running the client.
Front running the short covering. Yeah.
Yeah. So, but then at that point, I'm like, wait a minute. How does this work? Like, so I became very well versed in fundamentals after that because of that education. I mean, I made money from trading, but it was fascinating because after that event, no bank would finance mines because they were worried, right?
Yeah.
Right?
Yeah. So that was a different gold regime back in those days, the late 90s, the early 2000s. The volatility in the gold and silver markets were much less than we see today. And Barrick had this massive hedge book back in the late 90s and the early 2000s. And they got really punished by the market, by investors, as gold launched into that bull run from 2001 to 2009, and they had to unwind the hedge book. And actually, I don't recall the exact year they unwound the hedge book, but it's probably like 2005 or 2006, and that actually drove gold into overdrive when Barrick fully wound down its hedge book and got rid of all the short calls and long puts and whatever they were doing. But yeah, so that was a really common thing back in the 90s. Miners would hedge their production. It was very common.
Right. But they, to be fair, they should hedge their production if they want to run their business like a viable concern, because they weren't hedging in the 80s. They were Texas hedging. The 90s come, they're like, oh my God, Clinton comes in, they start rehypothecating gold a lot more, and they've got no cash flow. So now it's like, I need to buy puts because I'm worried about making my payroll. I need to sell calls to offset the cost. I need to hedge my futures. I'll hedge a couple extra, get that money and do a carry trade. My bank will protect me. And now they're over hedging. And this manifested, like if you're looking for like proof of this manifested in 97. You see, in silver, the producers in silver are the ones who got killed. They were pulling out, let's say, 10 million ounces of silver per year. I'm making a number up, right? But they were hedging 20 million ounces.
That's crazy. Yeah.
But they were doing that because the banks, their buddies, the banks, were saying, hey, I can always lend you 10 million if it ever gets squeezed. And so Buffett came in and said to the banks, I'll borrow your silver. And the producers said, we need to borrow some silver because we don't have enough production. And the bank's like, sorry, some old dude bought it, and that was it. The shortfall in production and the over-hedging just destroyed the 90s market. And sadly, that's when miners became a buy. And I say sadly because Wall Street and the financial world, because I started to warm up to miners after that. In the O's to 2012, I was a miner person. Not specifics, but general. I was like, I understood the market, I understood the fundamentals. I'm like, all right, these guys aren't going to hedge like they used to. They'll do well. But Wall Street punished them and treated them like a carry trade, right? I mean, it was horrible what they did. And management was killed in the 80s from not hedging, killed in the late 90s and O's from over hedging, Barrick. And now I'm like, so I held on to them. I did okay, nothing great. But, and then Paulson comes along and he wants to kind of like make them smart back in the O's, 2011, 2012. And he starts to do activist investing. And I'm like, I'm in the right place. Paulson's doing it. I'm like, I'm a minor genius, and I was going to minor, I was going to minor shows, investment shows. And by the way, we'll talk about this when we get to the actual minor section. I know you want to talk about minors. But by the way, I was like, oh my God, these people, that they were scared. I could tell they were scared. And anyway, Paulson one day says, I met one of his portfolio managers. I forget the guy's name, but I'm like, so what's going on with miners? I was on a panel with him, miners and money. He goes, oh, we're getting out of that. I'm like, why? He goes, we just can't get them to do what we want. And I said, well, is that because of them? He goes, well, it's because of them, but it's because Wall Street has punished them so much. They have no budget for anything. So there's no story. And we're all into the whole neoliberal, neo-Keynesian mindset. The dollar is king. Gold is, a pet rock. And he goes, we're getting out. And then, so I got out. So that's basically what happened. And then I just traded energy for after 2011. I traded energy from 2012 to 2018. And then I got back into metals. And then COVID happened. And I said, I had the derivatives understanding. I had the physical understanding. And oh my God, and I knew China was buying gold before. China has been buying gold since 2009, slowly. I'd seen that. I'd done a study of their market structure. And I said, shit, gold is the new oil. And so I started GoldFix. So that's it. Right place, right time. I got lucky.
That's the story. Yeah. So the late 90s, I was too young to be a trader in the late 90s, but I know the history. And so there was Bre-X. So there was a major fraud in the gold.
Bre-X, I remember that. Yeah.
And then there was all these hedge book explosions that occurred in the late 90s. Yep. And then you had the Bank of England selling out all their gold at 250. I think that was in 99 or 2000.
Round bottom.
Right? Yeah. So that was a cataclysmic capitulation moment. And that was also the dot-com bubble. So everybody was chasing all the internet mania. Nobody wanted anything to do with gold and silver. And that put in an incredible bottom by 2001. And so, yeah, so, kind of my story is my dad got into the gold mining sector in 2001, started getting really interested and putting together a portfolio. And that's sort of how I got the bug.
Oh, nice.
Yeah. So look, let's fast forward to 2025, because I think most of the viewers probably want to get up to date with what's going now. So obviously we're in this incredible precious metals market environment. A lot has changed. I mean, the game has changed in so many ways. I don't think we can even cover them all. But sort of let's talk about 2025, Vince, and how has this year been for you trading gold and silver and obviously commentating on gold and silver, and sort of maybe we can start at the beginning of the year and get up to where we are today.
Okay, yeah. I mean, you have literate metals people. So, I mean, I think something happened in first of all, 2022 is when it's talked about all the time now, but back in 2022, when Russia invaded and we froze their assets, we basically said, treasuries, which are the parents of dollars, are no longer sacrosanct. We can confiscate them. And that's what we did to Russia. And so the BRICS, which have been thinking about de-dollarizing, or at least hedging their bonds, their US dollars, with some gold, started to move into overdrive. And China started to move into overdrive. Now, Trump gets elected late 24, and this is with hindsight. I didn't see this, but this is with hindsight. China had a problem with Trump in 2018 because of the tariffs back then, tariff man. And they took it on the chin, so they started buying a lot more gold. And in late 2024, I believe my sources and my insights tell me that in late 2024, the U.S. politically got off its behind and said, oh, wait a minute, we're falling behind in rare earths are obviously at the top, right? We're falling, look at what they're doing with us. Like, we knew what they were doing with gold, but it's just not that important. At least we don't think it is. That's the arrogance of incumbency, I guess you could say. And my understanding is from a source in China and a source here is that in late 2024, we started to pay attention to the fact that China was taking so much gold. We knew it, but we didn't care before. And so that's when we started repatriating. We started bringing gold back and silver. And so we started treating all the precious metals and the important rare earths like they were precious and rare. A lot more of it comes back. We start taking it. January comes, Trump's elected, China's buying hand over fist. The BRICS are all buying now. China starts launching into these, starts putting meat on the bone for their plans, which is to create an alternative system that doesn't use dollars, isn't dependent on dollars, has gold as its root or foundation with multi-currencies. And we're aware of that now, the M Bridge and all those things that we were talking about for years. And we have Liberation Day, you know, and at that point, and here's what's a little bit crazy. The reason we got the spike was because of tariff fears, but they never materialized on gold. You can't tariff gold. You can't tariff money. You know, if you do, you're going to shoot yourself in the foot. But China's hedge funds, which are really banks, which are really trading arms of the central of the Chinese Communist Party, they started accumulating gold to run it. I was told to show that the tariffs are bad for the dollar by making gold go up, and it worked. And then everyone's buying gold for de-dollarization in Asia. Everyone's buying gold for inflation fears in the U.S. or debt. So you've got different sides of the world buying it for different reasons. The dollar's going down. And in April, it just stops. And for 4 months, the market went sideways. From late April to August 26th. The reason I know that date is because on August 27th, gold started to move, and I got what's a trading signal for me, one to just close my eyes and get super long, and I did. And I discussed it with subscribers, but I don't give trade recommendations. But it's basically what he did. So we had 4 months of sideways movement, and during that 4 months, China was buying all the dips. Insurance companies were buying for China, right? You know, for those who aren't familiar, this is what China's doing with gold. They're doing with gold what the U.S. did with stocks under Reagan. Under Reagan, the U.S. said, you know what? Insurance companies can own more stocks, and you can offer them in variable annuities. And so that created locked-in demand for stocks, and that created the financialization wave. China is doing the same thing with gold. And their bonds are yielding, what, 1%, 1.5%, 2%. And so now they're saying to their insurance companies, you can put gold in an insurance policy. To their people, they're saying you can buy gold. Like the Chinese have savings accounts like we do, and our savings accounts or checking accounts are linked to our stock account if we want it to be, right? You got your mutual funds, lots of stuff. Well, they buy physical gold directly from their savings accounts. So all this stuff trying to approach the whole thing from top down and bottom up at the same time. Top down, we're changing the rules. We only want gold. Bottom up, we're going to liberalize gold ownership. And that's what they kept doing and doing and doing. And then in August, I don't know what caused it, but in August, the market just started to take off again. And the word was that China was going to another level. And that other level was they're going to they're planning on actively using gold as collateral instead of treasuries amongst BRICS countries. Now, it hasn't happened yet, but I could bore you with that, but we'll get into it. I'm sure you read me talk about it before. But there's all these pieces that are just falling into place, warrants or what have you. So in August, late August, I got long gold, and it was supposed to give you an idea like how crazy it was for that time period, how orderly crazy it was. I use a system that tells me when volatility is about to expand. And when volatility expands, it usually lasts 3 to 5 candles or 3 to 5 bars. So that could be hours, weeks, days, months. I rarely get them that last more than 5, right? Never get them lasting more than 5, and rarely get them last more than 3. And usually they're on days. Well, I got a signal for a weekly in August, and it lasted. We had 8 weeks of a rally, and I could say in my career, and I've been trading for 30 years, I've never had a signal be that clean, that pure, and that robust. So we just hit a home run in terms of, and I don't mean money, I'm saying we just hit a home run in terms of a market that's no longer sleepy. Like, this is going to go on for years. It's not going to stop. But I mean, so in 2025, just to recap, we rallied because of Trump, and then we went sideways for 4 months, mysteriously, I don't know why, while China was buying. Then we had this breakout, and now it looks like, I'll give you a little tinfoil hat here. I noticed that the rally in gold stopped as the conversation between Trump and Xi started. It's almost like there was a truce. China, I know that China was buying in August. They're just like buying, buying, buying. If there's going to be a conversation, then we're going to make the market make you look bad. And so Trump had to capitulate on some things, and so they stopped buying gold. That's my impression. But that's 25 so far, if that helps.
Yeah, that helps a lot. You definitely delved into a lot. So yeah, that I obviously was there. I saw that August breakout take hold. I saw you comment on it as it was unfolding. That is one of the most incredible, memorable technical chart breakouts I've ever seen in gold in my lifetime, maybe ever. I think I've analyzed gold price action through every period of human history.
Right.
That was memorable. I mean, to have a 4-month consolidation like that is like ping pong in between 32.50 and 34.50 for 4 months. And then it just starts to gently come up to test that 34.50 resistance, and then it busts through 35, 35.50, 36, and it just doesn't stop. You know, like you said, 8 up weeks in a row at $1,000 an ounce. Incredible. And I like what you said there about how it had a lot to do with China and the US. China was accumulating throughout the summer. And then whatever happened at the end of August, they said, let's put the pedal down and put some pressure on the gold market here, put some pressure on the US. And then I think the correction that we're undergoing right now has a lot to do with what you said. At some point in mid-October, a truce was called and said, let's cool this off. It's not in our best interest for either party to have this get too adversarial. Obviously, both China and the U.S. could hurt one another, could harm each other's economy quite badly if they wanted to. It'd be bad for the world, right? So there's a truce called, And so we're back into a cooling off period, sort of like we were in June, cooling off period in the gold and silver market, and potentially another buying opportunity. So now I'm going to ask you, we're in the correction. We're in a sort of a sideways around 39, 4,000 an ounce. Silver's 47. What's next? How long do we need to cool off for?
Yeah. Had we not cooled off for 4 months, I'd say we need to cool off for 4 months. So but we've had 2 months of a rally. I don't know, and I don't know, but I'm going to give you. See, I'm not a technician, but I'm more of a flow trader, and I can pretty much confirm what I see in patterns by talking to people that trade the markets, like myself. And what ends up happening is when I get it right, I get it right from the point of view that I know who's buying here, and that's where your support becomes, which is what technical analysis is all about. Technical analysis are the fingerprints of the players. So the reason I'm bringing this up is because you would have to look at this as a technician. But after the high in April, which, by the way, was capped, in my opinion, you can never prove me right or wrong, but in my opinion, it was capped by the Bank of International Settlements in April. Then the market dips, chops around, and then the 4-month flow goes. All right. For the weeks after the sell-off and stabilization, there's a ledge that forms. And as a paranoid long, I kept saying, well, this ledge is going to break and they're going to spoof it lower and it's going to go lower. And we got the break, but it was after the ledge was formed by China buying. That was the insurance companies and the central bank buying more. And then there's a big candle where it breaks that ledge and then goes back up in the next candle. And then it just like starts to chop around at the same level again. This is very early, right? I think I've identified another ledge. If you look at the market now, it's the beginning of, I don't know what the technical pattern's called, but we had the high in October, and that was capped by the BIS and the plunge protection team and whoever wanted to make sure that you didn't want to go into that meeting with G with gold on the all-time highs. So it got knocked down. And now, as you smartly said, it's a ceasefire or a truce or everyone's taking a breather. It's a prisoner's dilemma situation that the U.S. and China are in. That's really what it is when you think about it. And so maybe everyone decided to go their neutral corners, but the ledge is there again. And we broke the ledge and it's there again. And I'm seeing the same players do now what I saw in April. And in April, here's what I saw. I saw a bullion bank, who shall remain nameless, destroying the other bullion banks. They were long options and they were buying low and selling high and just running the market in. Everyone would get long on the highs, they'd sell it. And they were the monster in the market because they also saw the Chinese buying underneath. And so the channel got formed because of this behavior. And eventually everyone got trained to just stay in the channel. Well, there's a new channel forming. We're very early. I could be wrong, but I feel like this pattern is going to behave, is going to replicate. Now, this is what I don't know, and I would defer to someone like you on this. I mean, what do I look at to determine how long this could consolidate? Aside from the whole, I look at events, I look at flows. I mean, should I be looking at GAN lines from the low to the high? Am I looking at speed lines? Like what? I don't know. How long can it be? I got to say at least 2 months. I'll tell you this, though. If it doesn't crack lower in 2 months, like significantly lower, then the pattern's going to repeat again. Like that's where I am. So, I mean, what do you think in terms of how long it lasts?
Yeah, there's so many different tools, so many different indicators, so many different you could look at a lot of different currencies. You could look at correlations with treasury yields. There's so much stuff. And honestly, it could all just prove to be noise. But I would say 2 weeks to 2 months is probably the time period that we're looking at here for a consolidation to take place. And I agree with you. I want to compare to the April to August period. So some of the things that formed during the April through August consolidation were a series of higher lows, a
Yep.
series of lower highs,
Yep. Oh yeah.
and a tightening consolidation. So you start to use your Bollinger Bands, your Keltner channels, stuff like that.
Right.
And you know, it starts to hug like the 40-day moving average. It just starts to do an oscillation around like the 40 or the 50-day moving average. And, you know, look, the longer the consolidation, generally, the bigger the rubber band for the eventual breakout.
Right.
But, you know, we're in a bull market, Vince, you know, and so it could be a 2-week consolidation, and then it resumes. You know, we just don't know.
Right.
And there could be these outside factors that come in that are just unforeseeable and unpredictable at this point in time. And, you know, you and I both know that markets can obviously be unpredictable. If they were predictable, we'd all be rich.
We'll be rich, or we'd all or we'd all be poor, depending on how you look. Because the other people would tell us. Can I add something to that?
Yeah.
You mentioned moving averages, and I'm just thinking we're like having a technical conversation here. So like the 48 moving average, and I did notice that the market had to, I wouldn't say had to, but the market, the 50, 100, and 200-day moving average started doing a dance during that time frame, you know, before we broke out. So if it's 2 weeks, you're right. And if it's 2 months, then I bet you our moving averages are going to be in that area again. Like I feel like I want to be bullish on a breakout above, on a price action above, or I want to be patient and wait for these moving averages to catch up to the market, either by rallying the moving averages or selling off the market. That might be it. That's the physical stuff. That's the physical stuff. I think China's buying again. I mean, I know they're buying it. They have to be. I mean,
well, one more thing I'll note: the April low on spot was 29.56. That lined up exactly with the 40-day moving average.
Did it?
Yes. Now the late October low was 38.86. Lines up exactly with the 40-day moving average. So we got like a pattern repetition here. Exactly. And so now I would just look for a higher low to be put in place, and then another higher low to be put in place. And let's consolidate. Let's bore people. Let's get gold's name out of the headlines again. I don't want CNBC or Wall Street Journal talking about it at all. Then we'll be ready again. You know?
I'm in. That's a great story. I mean, that's my pattern. Like what I really like when I talk to someone who understands their discipline very well, and I don't, but we come to the same conclusion from different points of view. And I go, that's a pattern. Same buyer there, same buyer there, same seller there, same seller there, and then the fingerprint is the 40-day moving average. Is what you're saying so far, anyway.
Yeah, so far. And look, it could be proven wrong at a later date, but right now, I like the repetition. I like the patterns forming here. I actually like this price action. I know some people, like I go on X and I see some of these technical guys who just do charts only, don't really follow gold specifically, and they say, "Oh, that was a weak bounce in gold. That was a weak bounce. This is a bearish market." And I love to see that. I actually love to see that stuff because now we have contrarians in the room. Not everybody is saying they're bullish on gold anymore.
Right.
I like that because, honestly, in early October, we got too much of a consensus on gold and silver. It was a little, and I got all these guys doing these X spaces saying that there's a shortage of physical silver. And look, yeah, maybe there was a shortage in the short term, but there is never a long-term shortage of gold or silver. It's just a matter of price.
Right. It's price and time. I got to find it.
Yeah,
exactly. That's right. You mentioned, oh shit. What did you mention in April? What did you mention about April?
The low at 29.56, the 40-day moving average.
Yeah. Something else. I don't know, but
Liberation Day tariffs? Because,
Well,
obviously that announcement roiled all markets and sent gold plunging at first, but that was a knee-jerk fake move that
right.
actually then turned into a huge rally.
Right. Yeah, that was. I remember when that happened. When gold dropped, people that were watching that said tariffs are recessionary, so everything sold off, gold with it, and then they backed up and they said, "Wait a minute, tariffs are recessionary, but the price of stuff that we have to buy goes up. That's stagflation." And you started to see U.S. bonds sell off. You started to see the dollar, bonds, and stocks sell off at the same time. And that was really, really bad. That's like, dollar and bonds should be inverse. Bonds and stocks should be inverse. But when they all go down, when they all go up at the same time, we have an expression. We say that's American exceptionalism. Strong dollar, strong stock, strong bonds, yay for us. What is it when they all go down? And that's what started happening. And that's why Trump had to back off on some of the tariffs. But when those three started to drop, that's when gold just took off. Right after that dip you're describing. Yeah, I think I have a little bit of a plan now. I wanted to mention miners in this context as well.
Okay. Go for
there
it.
is one. There in the context of what happened in April. As we went into the end of the year, I started noticing from the reports that I see that they started talking about miners again. Now, RBC always talks about miners. You got your normal, but Citi had this phenomenal piece about miners, and I shared it with subscribers. But I really plugged into it because they were saying back then, gold is at a once in a 40-year. Miners are at a once in a 40-year opportunity. And I'm like, oh, okay, miners are cheap. Let me read it. No, it wasn't about miners being cheap. Citi was pitching to me and you as investors to buy miners because they're going to hedge and lock in all this money. And paranoid that I am, well, that's because they just want miners to sell. That's what they always do, They always get them to sell so they have their hedging. But then I started seeing Michael Hartnett, who's at Bank of America. He never said the word miners. He just said, you got to have some of your money in this kind of a barbell trade. You got to have some of your money in everyone has their money in American stocks. Fine. Tech, right? He's a stock guy, right? You should take some of your money, you should put it into international stocks and into materials. I was like, what the hell is materials? And I know what it is, but what is material? Never got specific. Didn't say base metals, just said materials. And for 6 months, he was saying, you got to have some money in materials because of the inflation play. And now I got Citi talking bullish on miners. I got RBC putting out these really nice reports again. I go, wait a minute. I realized these banks have been short miners forever. They've been using miners as a fund. This is me talking as a commodity guy applying it to miners. They were short miners and taking the money and buying tech stocks like they were doing with the meme stocks. And they started covering it. It started percolating. And then the percolations with all my miner people like you and a couple others, they were like, oh, miners looking good. They're not making new lows. Like stocks will make new lows and miners won't. I'm like, oh, I guess there's a buyer out there. It was them covering shorts. They were covering shorts on the dip. Then the reports came out and then boom, 90% higher. And I was like, that's fantastic. So I want to see, to add a footnote to what we're talking about, I'd like to see something in miners that mirrors that, for a catalyst. Maybe miners need to sell off a little bit. Maybe they do. Generally. Anyway.
Yeah.
So
so generally, I also like to see gold miners start to outperform the metal itself. Okay, at a bottoming process. As we get further into the bottoming process, I like to start to see that outperformance. And that usually gives me like the final confirmation, like, okay, we're about to start to move up again, You
mean like gold makes a new low, but the miner doesn't, that type of thing?
Or gold is just trading flat and the gold miners are up like 1% a day for like 3 days in a row or something.
Yeah. That's the next wave. I think Elliott wave is probably something. I mean, I don't know it, but I think Elliott wave might be might be something to look at right now. Maybe we're in a 4 or something like that. I don't know, but I tend to think that's really true, because the bullion banks were recommending. They started recommending gold. They never done that, right? So once they started doing that, that's when the miners started upticking, and that's when I started seeing new lows in gold without a new low in miners. And so I bought Newmont. I'm very plain vanilla. I bought GDX and I bought Newmont, and I don't know the management. It's all about management. You have to know the management of these things. And I did well, but of course I got out too soon, right? Because I didn't understand it. I was like, oh, this is not going to last long. But I think that I started in fundamental analysis, right? So I started as a fundamental analyst at Lehman Brothers, studying fundamentals, and I never understood why, price to all-in sustainable cost, right? Like there's only 2 types of leverage in the world. There's financial leverage and there's operating leverage. And I would just say, all right, the commodity has the financial leverage, and I'd say, all right, give me the miner who's got the operating leverage without a lot of debt. I mean, give me that miner. Like they never worked. But now they're working. You know what I mean? Like now it's like, wait a minute. Like with all-in sustaining costs at 1,500, you didn't want to buy a miner at 3,000 with gold at 3,000, and now you want to buy it at 4. Like it really feels like everyone was so asleep at the wheel and so addicted to the NVIDIA story that it was a gift for us. Anyway, it's going to happen.
Well, yeah. So there a couple of things happened. The 2021, 2022 period,
right,
was a period of a lot of cost inflation for the gold and silver miners, to where even when gold was trading around 1,900 or 2,000, their costs were creeping higher. And although they were profitable, the margins were not expanding. And in some cases, they were actually getting squeezed, like Newmont and a bunch of other ones actually saw their margins.
Energy or administrative? Like what was it back then?
It was a lot. It was labor costs were going up. The energy costs in 22 surged after the Ukraine invasion.
Right.
And a lot of so this is one thing that a lot of newbies to the miners don't get, is that just mining is capital intensive. So you have to, they have to outlay CapEx every few years to just refurbish or expand the mining operation, keep it safe. There's always new costs that are just coming up. And especially with these really big companies with multinational operational footprints,
right,
there's a general cost creep in the industry. So 2025 has been, so since early 2024, the margin expansion we've seen in the gold and silver mining sector is almost like nothing that's ever been seen before, because the cost increase maybe since early 2024, we're talking about like 10% over the last year and a half,
right,
whereas the cost of the price of the product has doubled, right? So the margin expansion is exceptional across the industry. It's absolutely been exceptional. And you see like Newmont quarterly free cash flow of like $2 billion, right? Yeah, it's never happened before,
Right.
Vince, let's put a bow tie on this, because I know we could talk for hours. I want to ask you sort of a 2-part question. If you're talking to a newbie investor, somebody who has some savings, but they've never bought physical gold and silver, they've never bought a mining stock, they've never invested really in hard assets, but they watch guys like us and they kind of have an idea of what's coming here over the next several years, the end of the fourth turning.
Right.
How would you recommend that they invest?
Well, I would say a newbie. Interesting. Who the hell wants to go out and buy gold and silver at these prices if you're brand new to the game? You know what? Mortgage the kids, sell the house, and buy platinum, and we'll just talk about it some other time. No, I'm just kidding. No, but it is. You know what I like? If for a new person right now who's got no physical experience, I would say and I'm not saying this because you're a miner guy. We were talking about this beforehand. I would say you want to buy something that has cash flow. You want to buy something that's got free cash flow that can either give you a dividend or not, assuming they have management that's not over-hedging their book, or make a proper acquisition. I would say I'm talking about a person who's a financial person who's looking at precious metals. I would say to them, the first thing you should buy is miners. And which miners, I don't know. So I would just say GDX and GDXJ. And from a technician's point of view, those indexes have actually broken out against the 60-40 portfolio, which is something that Jordan Roy Byrne talks about a lot. So the first thing I would say to a person who has no exposure at all, I say, do you own your house? And they'd say, yes. If they said yes, I'd say, do you have a mortgage? They'd say yes. I'd say, well, then go out and buy miners. Now, if they don't own their house, I'd say, well, then you should buy some physical gold. And the reason for that is I want to hedge the dollar. And there's two ways to hedge the dollar. One is by buying a company that will throw off more dollars as their profit margins increase, like a miner. And the other is, that's an equity. And the other is to buy a physical asset that will increase in value as the dollar depreciates. So if you own the house and you're leveraged on the house, you're short dollars. So go out and buy miners. If you don't own a house and you don't have the funds for a house, let's say you're renting, go out and buy some physical gold. That's what I would say. That's how I look at it. I look at it, there's two ways to hedge dollar debasement, if that's your concern. Debasement, inflation. Inflation is a manifestation of debasement. You go out and you buy a company that's going to throw off dollars, that's going to keep pace with the inflation. That would be a gold miner. Or you buy the physical gold. The reason you don't buy the physical gold, in my opinion, just making it up, the reason you don't buy the physical gold first is because you own a house, you understand stocks, you understand dividends, buy a miner, and then go buy some gold on the next dip. That's what I would say. That's my advice to a new person.
Okay. And now final question. In South Florida, in my neck of the woods, we have a lot of high net worth investors, people in their 70s and and 80s, the baby boomers, and people who have a lot of money in money market funds, like yielding 4% or whatever. How could precious metals or maybe even miners be a benefit for their portfolios?
Well, if you got a high net worth individual with a significant amount of money in a money market, right? I would say, let me think about that. That's a good question.
Yeah, especially like if the Fed is going to cut to 3% or even to 2.5 next year, suddenly the returns in that money market are not going to be nearly as attractive, and they're probably not going to keep up, with inflation.
Yeah. That's okay. This is good. So I want to, I can address that community, that group of people, and I want to try and do that right now. If you're a high net worth person and you understand the markets in general, I assume you're market literate. You should, and you want to have a hedge for debasement and for lower rates. There's a couple things that I can suggest. Not telling you to do it. You should do what's best for you. But the first thing is, I assume you have a decent amount of your net worth into equities, and I assume you see gold as a potential store of value as a replacement of equities. As a replacement of bonds. And I would say, if you want to stay in equities, let's say you've got 70% of your money in equities and 30% in bonds, and you're going to be encouraged at the GLD and SLV level to take some of your tech equities and sell them and put them into GLD and SLV or whatever ETFs are out there, right? And they're going to say, and miners as well. Miners are good. And they're going to say, I'm going to tell you, it's called barbelling. Basically, the market, I'm already long stocks. That's one of the barbell. What's my hedge for stocks? Used to be bonds, right? Now it's not bonds. But what they're doing is they're telling you to sell Goldman, all the banks, and I don't think they're wrong. They're telling you that as a safe haven, gold is replacing bonds. I don't disagree. But if you're a high net worth individual and you have money in the market, you want to take some money out of stocks and put it into gold, out of stocks and put it into stock miners. I don't really think you want to sell bonds. I don't really think you do, because there are scenarios where gold's going to go down and bonds are going to go up. But there are very few scenarios where stocks are going to go up and stocks are going to go down and gold is going to go down. So I guess what I'm saying is I'm concerned that this latest wave of high net worth individuals is going in there buying gold at 4,000 and buying miners because they're rolling out of tech stocks into the next thing they think is going to go up. That's not the way to do it, right? Because when the market sells off, they're going to puke their gold with their tech stocks. I don't want that to happen. But I guess the straight answer is it's based on this. The United States of America, if you're a high net worth individual over the age of 50, the United States of America needs to manufacture again. And in order to do that, we need to spend money that we don't have to rebuild manufacturing, rebuild roads, et cetera, et cetera. That's the fiscal side. That's what MAGA is, or that's what Trump is trying to do. And it's not bullshit. See, no one's going to give us credit anymore. So we've got to sing for our supper. We've got to make and sell stuff to pay our debt down now. We've got to go out and get a job. We can't just, right? We can't just push paper around. You got your kids. Like, you know what? Go out and get a paper job. Go out and get a paper route if they still have those anymore. So that's what the fiscal side is doing. They're retooling industry. The Fed side, the monetary side, and that's where the CapEx reductions are coming from, the subsidies, all that stuff that Trump is doing. That's, build a data center. We need to do all that. And this is going to come right to gold. On the monetary side, in order for this to work, or at least to have a chance of working, Powell needs to get real rates to zero. And that's why the rate cuts should continue to happen. So rates may be 4%, but real rates need to be zero. So either we're going to have inflation encouraged, which we're having on the fiscal side, or we're going to have rates drop. And when those real rates drop, that 4% in your money market is not going to help you at all. You want to leave some money in cash, obviously. I guess what I'm saying is the reason, I'm just telling you, like, I'm 99.9% sure that there is no way out of this without a weaker dollar. No way. And it's not a doom statement. We need to make stuff, which means we need a weaker dollar to sell it. So Trump's going around to everyone in the world, Japan, Saudi Arabia, he's saying, listen, I'll tell you what, you buy more stuff from us and I'll weaken the dollar. Wink, wink. Right? So they're going to get discounts on buying stuff from us. And we have to do that. Otherwise, we can't make and sell stuff. I mean, that assumes they even want to buy it from us. So the conclusion is the dollar must be weaker against all the against all the BRICS countries, because they're the guys buying stuff now. And the G7 currencies are going to go to zero, aside from us. So I'm saying that you need to have your money in something other than your home, because homes will not be the piggy bank in the next run-up in inflation. They will not be. You will not be able to take as much money out. HELOCs are not going to be so readily available. And you might have a housing crash at the same time it happens, but you need to have a decent portion of your money in a physical asset or a stock that deals in physical assets that's going to throw off extra dollars. So I don't know what the percentage is, but real rates have to go to zero as Powell's going to lower rates. The dollar has to get weaker. And if you're 90% in tech stocks and China makes another launch about DeepSeek, DeepSeek, we did that for $5 million and it's better than your stuff. Well, our valuations and our valuations in our tech stocks are dropping as Chinese valuations are going up. American tech stocks are not where it's at. You got to have something that's real. That's my sales pitch.
Very good.
I would say put a chunk of money into put some money into physical gold or physical silver for me as well, and just forget about it, and then wait for miners to dip to buy them. Leave that money in cash. Wait for miners to dip to buy them. That's what I would say.
Very good. Vince, this is a great conversation. Can you tell the viewers how to read more of your content?
Sure. After you sign up for Goldfinger, go to GoldFix, right? No, that's right. After you sign up for Goldfinger, go to GoldFix. It's called VBL, Victor Boy Larry GoldFix, and you can sign up for that for free. Now, I will cover miners in the context of physical, and I will focus primarily on the drivers of gold, the geopolitics, the domestic politics, macro, geopolitical, secular, and all the things. And we do put out a lot of content. I don't think it's junk. We put out sometimes 4 stories a day just on metals alone. And if you sign up, you're probably going to feel like, this is too much. I don't want it. And I understand that. But just keep in mind that gold is grossly underreported. It's just guys like Robert and myself that are waking people up to it.
Very good. Thank you, Vince.
Thanks for having me, Robert. Good stuff.